hope you found this video extremely informative and a little bit entertaining, with Caleb around just saying his odd thing. In this video, it is on mastering the accounting rules, why are some accounts debited and then on the other hand accounts credited. There's our little entertainer, Caleb, and then the contents of this video. We're going to learn definitions. I'm going to show you examples of different classes like assets, expenses, income. I'll explain to you what a T account is. I use the T account in order to show you whether an account is debited or credited. Then I take stock of what we've learned already. We're going to know the rules. I provide you with an acronym to apply the rules. Then I work through some examples. Then my Gran is going to just say a few words. But at the end of this video, it is an extremely important video if you're doing accounting at any level, because what you do in accounting is all based on applying the accounting rules. I'm going to try and make you masters at debiting and crediting accounts correctly. I hope you enjoy the video. Best of luck. On this slide, we have a few pictures. This picture here that I've just circled is a picture of my office. Now, for my sole proprietorship, this office is an asset. I've put in here a picture of Caleb, and Caleb's sitting on a scooter. Let's call that scooter our delivery vehicle. That's also an asset. There Caleb has another scooter, and here is a laptop, and this is my family. So I've shown you examples here of non-current assets. Now, a non-current asset is a fixed asset or a long-term asset. Non-current means a period longer than 12 months, whereas current, that means the 12 months that we are looking at. Current in accounting means the 12 consecutive months that make up our financial year. There it's written there. So what is a non-current asset or a fixed asset? It's an item bought to keep for a period of time. There's no intention of selling this asset in the near future. For example, my office, I intend keeping that for my lifetime. This asset, a non-current asset, will be used to generate a profit for my business, and normally these non-current assets have value. Then a current asset, there's an example there of Caleb with his cash. An example of a current asset is cash, or an item that will be converted into cash within the financial year, the current 12 months we are analyzing and looking at. So an example of a current asset, another current asset would be trading inventory, debtors, but further on in the video I will give you lots of examples. For now, you need to know what is the definition of a non-current asset and what is the definition of a current asset. What is owner's equity? Here is a picture of Caleb making a sale. So he's bringing in income. This is a picture of my cell phone. The cell phone is an expense, or a mobile. You might call it a mobile. A mobile is an expense to the business. And then, of course, vehicle maintenance, specifically fuel, is quite expensive for the sole proprietorship. So owner's equity consists of what the owner puts into the business, capital, what the owner takes out of the business, drawings, for his or her personal use, and capital and drawings, they're known as proprietary accounts. And then income is the money we earn through business transactions. For example, a sale, where Caleb's making a sale. Expenses, as I mentioned earlier, things like the telephone account, vehicle maintenance, those are expenses to the business. So what we have here, and I'll introduce this acronym. Remember, we're looking at owner's equity. What is owner's equity? Owner's equity is what the owner puts into the business, capital, what the owner takes out of the business, plus the income earned by the business, less the expenses. And while I'm on this slide, income less expenses is either equal to a profit or a loss. So the owner is entitled to the profit, or else if it's not a profit and it's a loss, then the owner's responsible for the loss. If the income is greater than the expenses, there will be a profit. But if the expenses are greater than the income, there will be a loss. There are two ways to calculate owner's equity. Owner's equity is equal to the value of your assets less the value of the liabilities. I will explain what a liability is in a moment. Owner's equity can also be calculated through this acronym, and I will use it a lot in future videos. DICE. As you can see underneath owner's equity, there are 4 items or classifications, categories. You got capital, drawings, income, and expenses. And that makes, if I take an acronym, the D from drawings, the I from income, the C from capital, and the E from expenses. There's the acronym DICE. And to calculate owner's equity, I say what the owner put in, capital, increases owner's equity. What the owner takes out, drawings, decreases owner's equity, plus income less expenses is a way of calculating owner's equity. There are 2 ways. Assets minus liabilities, and you can use this DICE acronym. But I will speak more about it as we go on. So now you know the definition of capital, drawings, income, and expenses. That's an irritating hooter from Caleb's delivery scooter. Let's say the delivery scooter was bought by Caleb Education and money was lent from the bank, and the money had to be paid back over 5 years. Remember, the bank charges interest. So if the scooter costs 5,000, it's actually going to cost you quite a bit more with the interest. So that's a little introduction to liabilities. Caleb Education is liable to pay the bank back over 5 years. Now, what is a non-current liability? That is a long-term loan, a long-term obligation to pay back money if the period is longer than 12 months. Remember, non-current is a period longer than 12 months, whereas current is the 12 months that we are looking at. So a current liability, examples of a current liability, would be paying a supplier who supplied us on credit, which enabled us to buy now and pay later. We have an account with the supplier. I've included in this slide just the definition of a loan, which I did kind of explain at the start of this slide. A loan is money borrowed from a financial institution, and it's to be paid back with interest over an agreed upon period. So in my example, to pay for this scooter, we lend money from the bank. It's going to take 5 years, and we're going to be charged interest on the loan. I've also included here what is a creditor. In other words, a supplier. You might know it as accounts payable. When we have an account with a business or an individual, that means we can buy now and pay later. We have a credit facility with a supplier, and we're going to pay back according to the terms agreed upon. So the purpose of this slide was to explain what a non-current liability is and what a current liability is. Remember, I'm going to show you some examples on a chart in a moment, but a non-current liability is a long-term loan, a long-term obligation to pay back money. The period is going to be longer than 12 months. A current liability, we need to pay back what we owe within the 12 months to a supplier or a creditor, however you would like to call someone that we bought from on credit. I see my parents have popped in just to say hi. On this slide, I have a summary of all the definitions I have just explained. We have our assets, non-current and current assets. Then we have proprietary accounts, capital and drawings. And this here, remember, is owner's equity, consisting of capital, drawings, income, and expenses. Those are the two accounts, general ledger accounts, and two classes that have an effect on owner's equity. Remember, if you want to remember, what has an effect on owner's equity? Remember that acronym, DEADCLIC: drawings, income, capital, and expenses. These 4 items, classes, categories, whatever you want to call it, These four have an effect on owner's equity. Then also we went through non-current liabilities and current liabilities. And have a look at this. Assets, owner's equity, and liabilities. And that gives us the accounting equation. Assets, the value of my assets is equal to the value of owner's equity plus liabilities. That is the accounting equation. I'll speak about the accounting equation plenty in my other videos, but remember this video is just I'm introducing what you need to know in order to apply your rules. That's where we're going. Assets is equal to owner's equity plus liabilities. And now you know all the definitions of what we're going to use to learn the rules and apply the rules. I thought I'd throw this in quickly. Just a little bit of quick revision on owner's equity. You got your two owners accounts, proprietary accounts, capital and drawings. Then also income and expenses affect owner's equity. So the four things that affect owner's equity, the value of what the owner is worth, capital, drawings, income, and expenses, which gives you the acronym DICE. Keep rolling the dice, and eventually you will get a 6. So the acronym for owner's equity for the last time in this video is DICE. I hope you remember that for the rest of your life. I've included the following just to illustrate some examples here of what a sole proprietor non-current assets, some examples of non-current assets. There we have non-current assets and current assets. There I have a picture of the business vehicle. There we go. It's an example of a non-current asset. We have machinery, equipment, furniture. All these items here meet the definition of a non-current asset. Then we have examples here of current assets, stock, your trading inventory, debtors, another word for debtors, accounts receivable, petty cash, cash float. Right, those are examples of current assets. Not all countries will have VAT, but if you do use VAT and pay VAT, a current asset is input VAT. Under owner's equity, remember we got our acronym DICE, drawings, what the owner takes out. We can earn income in the following ways: sales, services rendered, rent income, interest income. These are typical business expenses. There's a picture of myself. I'm the owner of the sole proprietor. And then examples of liabilities. We got the long-term liabilities, non-current, and short-term liabilities. Creditors, you might call it accounts payable, and output VAT if you use VAT, if you're taxed VAT in your country, is a liability, a current liability. So here we have examples of all the different classes: assets, owner's equity, and liabilities. And there it is. our accounting equation. Assets equals owner's equity plus liabilities. The left-hand side will always equal the right-hand side. If you know your accounting rules and if you apply them correctly. I'm getting there. This is a powerful document. Once again, there's my accounting equation. Assets equals owner's equity plus liabilities. There are my examples of non-current assets, examples of current assets. We have owner's equity consisting of what the owner puts in, what the owner takes out, what the owner earns in income, and the expenses of the business. Remember, we're always looking at this from the business's point of view. The owner's personal transactions at home are separate from the business transactions, but the owner is entitled to the profit and responsible for the loss. Then there are possible liabilities that a business will have. If the business was financed through a long-term loan, if they bought property, there would be a mortgage loan, and obviously the current obligations need to be met. For example, if the bank is owed money. But this document here, I've put it all together because I'm going to use it in the future. I can demonstrate so much from this document when I start to put numbers in here, and we can analyze and interpret what has happened with the business. So this gives you a fantastic picture of all the accounts that a business could have. There might be more, but this is a good summary of which accounts are classified where. Land and buildings, it's a non-current asset. Bad debts, which is credit losses, falls under expenses. It's a good document to know really well, but even better if you know the definitions of all these classes. So just before we get on to the rules, I'm going to just show you quickly what a T account is. In front of you, you have the general ledger of Calibu Education, and I've taken one account, capital, to use as an example. Where does the term T account come from? Now, this general ledger account, capital, is divided into two sides. The left-hand side, which is the debit side, and the right-hand side, which is the credit side. This account, therefore, forms the shape of a T. So we have column headings in this general ledger account, capital general ledger account, for date, details, folio, amount. And on the right hand side the same, date, details, folio, amount. When a transaction happens, say for example the owner puts money into the business, the owner's account to record that is capital. The account will either be debited or credited. So the entry, according to the rules, by the way, this one will go in the credit side, but I'll explain the rules a little bit later. The object of this slide is to show you where the T account comes from, because a T account will be used by your lecturers, by you, and when you see them pop up a T account, you don't know what they're talking about. But now we are going to use T accounts to explain the rules and apply the rules. So now you know where the term T account comes from. It comes from the general ledger, and it's used really to explain transactions for workings, but it's not actually, you'll see, it's not a formal way of doing things in accounting. It's just used to show students accounting transactions. You will see what I mean in a moment. Just a little bit of trivia. DR is an abbreviation for a Latin word, debitera, and CR is an abbreviation for creditera. So that's why it is DR. But it means here in English, what we're going to do, debit and credit. After each transaction, there will always be a debit and a credit entry to the same value, debit and credit. This is called the double entry system. For every debit, there will be a credit to the same value.
I'm getting clever.
Are you getting very clever?
Yes, I am.
Yes, you are, my boy. Let's take stock of where we are at this stage. At this stage, very important, we covered the definitions of assets, capital, drawings, income and expenses, and liabilities. You need to know the definitions because you're going to apply them quite soon. We learned examples of what an asset is, what makes up owner's equity, and what are examples of liabilities. Then we're going to use T accounts in the next half of this video to apply the rules. And you all know now what a T account is. There's a nice rainbow color T account, and you've met my family. So what's next? We're going to learn the accounting rules, and we're going to apply the accounting rules.
A, B, C, D, E, F, G, H, I, J, K, L, M, N, P, Q, R, S, T, U, V, W, X, Y, and Z. Now my ABCs, now my ABCs. Next time we're going to sing with me.
If you're starting your accounting career, or if you're an accountant, if you're a student, you need to know your accounting rules like you know your alphabet. Your accounting rules are one of the most important, if not the most important, things you need to know in accounting. Here I have the different categories: assets, drawings, capital, expenses, liabilities. I got income as well. You need to know how to apply these rules. But first of all, you need to know and understand these rules. If I take, for example, here, assets, you know, asset could be your equipment, it could be a positive bank balance, cash, land and buildings, machinery. Those are examples of assets. We've learned that already. Now, if there's an increase shown here by the plus sign in the value of an asset, the entry will go on the debit side, the left-hand side. I have explained what T accounts are, the debit side and the credit side. These are the rules. Very, very important rules. So if there's an increase in the value of an asset, if I bought stock, for example, the stock on hand, the value of the stock on hand has increased, we will debit the account. If I sell the stock and the stock leaves the premises, there's a decrease in the value of the stock. The rule says if there's a decrease in the value of an asset, that's a minus sign, the account will be credited. So that's an asset. If there's an increase in value, the account is debited. I like to use an arrow in my explanations. If there's an increase, that arrow is pointing upwards in the value of an asset, the account is debited. Excuse me. If there's a decrease in the value of an asset, the account will be credited. So my example was, if I sell stock, the value of my stock on hand decreases, there's a decrease in assets, the account is credited. Let's have a look at drawings. If the owner takes out cash or stock for his or her personal use, drawings will increase and the account will be debited. If there's a decrease in drawings, say for example a correction of error, more about that later, but if there is a decrease in drawings, the account will be credited. A decrease in the value, and this is an increase in the value. Income, for example sales, if there's an increase in income, the account is credited. If there's a decrease in income, the account is debited. If the owner puts more money into the business, there's a capital contribution or a vehicle into the business, whatever the owner puts into the business. If there's an increase in capital, the rule says the account is credited. And for whatever reason there might be a decrease in capital, the account will be debited. An expense, for example stationery, if we purchase stationery, there's an increase in expense. An increase in any expense will result in the account being debited. If there's a decrease in an expense, the account will be credited. If we buy something from a supplier or a creditor, we owe the supplier more money. There's an increase in liabilities. The rule says if there's an increase in liabilities, the account is credited. When we pay the supplier, we owe less. There's a decrease in liabilities and the account will be debited. You need to know these rules like you know your alphabet. It will help you to apply the rules. You also need to know your definitions of assets, drawings, income, capital, expenses, and liabilities. I'm harping on it, but it is extremely important. Now, how are you going to remember these rules? In the next slide, I will introduce an acronym to remember these rules. Before I get to the acronym, I've included this slide where I've actually put in items. For example, trading inventory is an asset. If the value of the trading inventory increased, let's say it increased by 1,000, the entry will go on the debit side. An increase in assets gets debited. A decrease in assets goes on the right hand side, the credit side. Drawings, if there's an increase in the value of drawings, it goes on the debit side. If there's a decrease in drawings, it goes on the credit side. Let's look at sales, which is an example of income. I'll just put in a circle there, I for income. If there's an increase in sales, there's an increase in income, the account is credited. If sales for some or other reason gets debited, there's a decrease in the value of sales. If the owner puts more into the business, it's an increase in capital, the account will get credited. The entry will go on the right hand side, which is the credit side. Advertising is an expense. If there is an increase in an advertising expense, remember, increase in any expense, the account is debited. If there's a decrease in the expense, the account is credited. Accounts payable, creditors, is a liability. If there's an increase in liability, we've bought more on credit, for example, an increase in liability goes on the credit side. I thought I would just include this slide because I've actually put in an income account, sales, I've put in an asset account, trading inventory, I've put in a liability, accounts payable, and an expense. Capital and drawings always remains the same. What the owner puts in and what the owner takes out. Now I'm going to get on to the acronym to remember the rules. So that brings us to an acronym that we can use. An acronym I'm going to use, you might have another acronym, but here I have DEADCLIC. And what that means is when there is an increase in the value of the account, we debit. So remember, when there's an increase in value, we debit E for expenses, A for assets, D for drawings. When there's an increase in value, we credit liabilities, income, and capital. So your acronym is DEADCLIC. Debit, expenses, assets, drawings, and credit, liabilities, income, and capital when there is an increase. So there it is, debit, expenses, assets, drawings, credit, liabilities, income, and capital. And the acronym is DEADCLIC. When there is a decrease in the value of the account, it is the opposite. So instead of debiting, now there is a decrease in the value of the account. We credit the following classes: expenses, assets, and drawings, and then we debit liabilities, income, and capital. So do you see, we start here when there's an increase. That's when DEADCLIC applies. When there is a decrease, DEADCLIC is the opposite. What that means is when there's a decrease, instead of debiting, we credit the account. When there's an increase, liabilities, income, and capital, they are credited. When there's a decrease in value, we debit liabilities, income, and capital. So let me just rub that all out. Make it a little bit neater. So it starts like this. In order to remember your rules by an acronym, you need to know DEADCLIC. When there's an increase, we debit the following classes and we credit liabilities, income, capital. Let me give you a quick example. The owner bought trading inventory, stock. This is an interesting one to start off with. I'm using my T accounts, which I have explained. There are two accounts involved, and we'll make this was bought for cash. So the one account will be bank. So I'm identifying the two accounts. The one account is bank. The other account, I'm just going to call it stock. Correct name would be trading inventory. Now, by definition, bank has a positive balance. Bank is a current asset. Stock, by definition, is also a current asset. Quite interesting. Both these accounts involved in this transaction are assets. Bought stock for cash. What has happened to our bank balance when we paid out money? A decrease in assets, and the rule says credit a decrease in assets. Let's see what DEADCLIC says. When there is a decrease in the value of the account, credit assets. So what has happened to the bank balance? Let's make it, we bought stock for 1,000. Bank's an asset, decrease in assets. The rule says decrease in the value of the account, credit assets. So the entry was recorded on the credit side. That is the credit part of the entry. The debit, what happened to the value of the stock on hand? It increased, and an increase in assets must get debited. 1,000. And what do you know? Your credits equal your debits. So I've gone a little bit further than what I should have, but the purpose of this slide was to introduce the acronym DEADCLIC, to remember the rules so we can apply the rules to the general ledger accounts. So we correctly debit and credit accounts by applying the rules. So this was an introduction of an acronym. You might have another acronym. Your lecturer or teacher could have given you another acronym, but I'm using DEADCLIC. At this stage, you know the definitions of an asset, owner's equity, and liabilities. You also know examples of the above and what a T account is, and we've gone through the accounting rules, and I've given you an acronym, DEADCLIC, and you understand the acronym when there's an increase and when there's a decrease. So now what we need to do is we need to apply these rules on some transactions. So I've selected a few transactions and we're going to apply the rules. It's time to start applying what we've learned. I've given some steps here to deal with transactions. It might seem obvious, but you need to read the transaction carefully. The second step is you need to identify the accounts involved. You need to classify the accounts by definition. So the accounts could be an asset, income, expenses, drawings, capital, or a liability. So you need to classify the accounts by the definition of income and asset. Then we need to apply the rules that we've learned. So these are the transactions I'm going to work through over the next few slides. You can ignore taxes. We'll do taxes at a later stage. Taxes like VAT, maybe general sales tax. So these are the transactions. The owner makes a capital contribution of 100,000 Rand. Let's talk about rands today because I'm sitting in South Africa and the currency for South Africa is rands and cents. But if you're sitting elsewhere, it doesn't really matter. The principles are all the same. Calibu Education buys 5,000 Rand worth of stationery. So we're going to buy stationery and it's on account. Just stationery is spelled with the E, not an A over there. Then Richard, the owner, withdraws 250 Rand to buy flowers for his wife as he needed to make an apology. Our business that we're doing the books for, Calibu Education, earns interest on a positive bank balance. And then the last transaction that we will deal with is Calibu Education purchased a new laptop for the business.
Do it. Do it, Daddy.
Thanks, boy. Let's work here with a few transactions and apply what we've learned. So what I have here are the steps to deal with any given transaction. The first transaction I'm looking at is the owner, Richard, makes a capital contribution of cash of 100,000 Rand to his accounting online shop, Calibu Education. So let's apply the steps. What I just did was read the transaction. Step number 2, identify the accounts involved. Now, if I look at this transaction, I know from experience the one account will be capital, and the other account, seeing that it's a cash contribution, we're going to put it into the business bank account. Remember, we're looking at all these transactions from the point of view of Calibu Education, the business we're doing the books for. We're the bookkeeper of Calibu Education. So the two accounts are capital and bank. The third thing we need to do is we need to classify the accounts by definition. And if you saw that little image float in there, let's just see what is the definition of a current asset. A current asset is either cash or an item. You learned these definitions. So bank fits the definition of an asset. And what has happened to the bank balance of Calibu Education? It has increased. Capital is its own category. It's an owner's account. What the owner puts in will be recorded in capital. So now what we've done is we've classified the two accounts. The next thing we need to do, so there's the definition of capital. The owner's putting in cash into the business, capital. Now what we need to do is we need to apply the rules. For now, I'm going to use the acronym in this example, DEADCLIC. We have an asset and we have capital. According to the DEADCLIC acronym, when there's an increase in the value of assets, the account is debited. So what has happened to the bank balance? it has increased in value by 100,000. And according to the rules, if there's an increase in the value of assets, the account is debited. What we need to write here is the name of the contra account. So in the bank account, the account was debited. Y, an increase in assets. We're applying our rules, the acronym DEADCLIC. The name of the other account affected by the transaction is put in a column which is actually called details. So what happens to capital? Capital here will get credited because the rule says an increase in capital, when there's an increase in value, we credit capital. There it is, 100,000. And the name of the contra account, which goes under the column details, is bank. Then we will put in the date, 2023 August the 1st. I'll write this out neatly in a moment. Also on the debit side, 2023 August the 1st. That's when the transaction took place. So what we've gone is we've gone and credited capital and we've debited bank. So our debits equal our credits. And this transaction would have first gone through a journal. If the business receives money, it goes through a cash book receipts. But what we're doing here is, the point of this slide is I'm showing you why capital is credited. Money came into the business from the owner. According to our rules, an increase in capital must get credited, and bank is an asset. An increase in assets must get debited. Just to refresh, I've put in here a general ledger account to point out there are column headings in the general ledger for date, details, folio, amount, and that's on the debit side. Then the same on the right hand side, the credit side, columns for date, details, folio, amount. On this slide I've typed out what I scribbled on the previous slide. There's the transaction. The owner makes a capital contribution of 100,000 to the business. I'm using T accounts to explain the rules, why an account is debited and why an account is credited. These are the steps. Once again, read the transaction, I've read it. Identify the accounts involved, and we identified capital. By definition, it's what the owner puts into the business, what the owner is worth, and the money that was put into the business is going into the business bank account. I needed to classify the accounts. Capital is its own category, C. An increase in capital, according to the rule, I'm not going to put the rule up again, the account is credited. So the entry is put on the credit side. Under details, the name of the other account, the contra account, is entered. So we're looking at the capital account. On the credit side, under details, we have bank. That is the other account affected by the transaction. All transactions go through journals. This information would have been taken from the cash book receipts. You might know it as the cash receipts journal, and the amount was 100,000. So capital was credited. Bank has a positive bank balance. That's an asset. I apply the rule, and increase in assets, because the business bank account has increased by 100,000 after this capital contribution by the owner. The information went through the cash book receipts. Under details, we have the name of the other account. So there you can see there's a link between these two accounts. Capital was credited, and bank, because it was an increase in assets, is debited. And there's the date the transaction took place, 2023, August the 1st. It is very important to know your rules and to be able to apply your rules. If you know capital was credited, don't just think, oh, because capital was credited, for every credit there must be a debit. Rather apply your rule. An increase in assets means debit. That is why a bank is debited, not because capital was credited. And for every credit there must be a debit. Apply your rules to both accounts. Let me rub this all out so you can see what it should actually look like in your books without the scribbles. Actually, it's not really in your books. These are workings just to explain why an account is debited and why an account is credited. And like I said, I'm using T accounts. Okay, let's go on to the next transaction. This is the next transaction. We can see here Calibu Education, and you the bookkeeper of Calibu Education, buys stationery worth 5,000 Rand on account. So we've bought this stationery on credit. Buy now, pay later. This is what's on my desk. A pair of scissors, some pens and pencils, stationery. And that stationery holder was made by the little man, Caleb. He gave it to me for Father's Day. So steps to deal with the transaction: read the transaction. We've done that. Identify the accounts involved. So we're looking here. We bought stationery. So the one account will be stationery with an E. The next account is creditors control or accounts payable. Now, if there was only one creditor, we could write here A, B, C stationers. But in the general ledger, the creditors control or accounts payable is a summary of the individual creditors. The individual creditors or suppliers with whom we have accounts, they will end up in the creditors ledger. So the general ledger account is, I'm going to use creditors control. And the other account, what did we purchase? It was stationery. So now we classify these accounts by definition. By definition, stationery is an expense. By definition, someone to whom we owe money, an individual or a business, we are obligated to pay them. It's a liability. So there we go, my definitions. Let's see if I've categorized or classified these accounts correctly. Yes, creditors control is a current liability and stationery is an expense. Now I can use the rules if you've learned it like this, or if you know your acronym DEADCLIC. So let's apply the rules. Step number 4. So stationery is an expense. The rule says, you can check the rules, an increase in expense, I will use this up here, the account gets debited. The amount was 5,000. This was bought on credit. It will go through the creditors journal, and let's make it number 8 because August is the 8th month. The name of the contra account is creditors, and the date 2023 August. Let's make it the 5th. I will type this out neatly on the next slide. But my point is, an increase in expense, the account gets debited. Now, creditors control is a liability. An increase in liability, the rule says an increase in liability, the account gets credited. 5,000, it would have gone through the creditors journal, the contra account to creditors control, specifically ABC stationers. That's who we bought the stationery from. The contra account is stationery. I will write it out neatly. 2023 August, I think the date was the 5th. So there we go. The point here is stationery was debited. Why? Because there was an increase in expense. Creditors control or accounts payable, the obligation to our creditors got bigger. There was an increase in liabilities. The rule says it must be credited. Right, let's go on to the next slide where I have done it more neatly. So here we go. I've written this transaction out neatly. Calibur Education bought 5,000 Rand worth of stationery from AB Stationers on credit, on account, buy now, pay later. Stationery we identified as an expense. There was an increase in expense. The rule says the account must be debited. So the entry is on the debit side of this T account. Increase in expense, the rule is debit. Under details, you got the name of the other account affected by the transaction. Creditors control, you might know it as accounts payable. I'm using creditors control. We identified as a liability. We classified as a liability. We owe more, an increase in liabilities. The rule says the account must be credited. Under details, we got the name of the other account, stationery. Where was this information recorded? In the creditors journal. And there's a cross-reference between the two accounts, a link. Stationery and creditors control are contra accounts. The one account was debited and the other account was credited according to the accounting rules. Let me rub that out so you can see what the T accounts look like without any scribbles. So there you go. Stationery was debited and creditors control was credited according to the rules. Okay, let's tackle this next transaction. Steps: read the transaction. Richard, the owner, withdrew 250 Rand from the business petty cash to buy flowers for his wife, as he had to apologize for, you can complete the sentence, the transaction. So the owner of the sole proprietorship has taken 250 Rand from the petty cash. So we read the transaction. We need to identify the accounts involved. Now, if the owner takes anything from the business, the one account will be drawings. If the owner takes cash or stock from the business for his or her personal use, the one account will be drawings. Now this 250 Rand was taken from the petty cash account. Petty cash is money that's kept on the premises to pay for small items, maybe coffee, tea, those type of things. But the owner here has taken 250 Rand for his personal use. So one account is drawings and the other account is petty cash. Now, by definition, I'll just run through this again. Petty cash is a current asset because it is cash. So petty cash we classify as an asset, and drawings, as I mentioned, is what the owner takes out of the business for his or her personal use. So what we've done now is we've classified the accounts, and I have taken the definitions of a current asset and drawings. Now I need to apply the rules. I've decided for this example to use the acronym again, DEADCLIC, but this is the opposite. This table here is showing a decrease in the value of the account. So if we look at petty cash, which is an asset, there is a decrease in petty cash when the owner takes money for personal use. Now, according to the rule, when there is a decrease in the value of the assets on our books, so a decrease in the value of petty cash, the account must get credited. A decrease in assets will get credited, in this case with 250. Now, drawings, there's an increase in drawings, and I haven't got the rules up here, but for an increase in drawings, the account will be, well, when there's a decrease, what happens to drawings? It is credited. But this now is an increase, not a decrease. So I'm saying this quite quickly. If there's an increase in drawings, it will be debited. So on the debit side of drawings, we're going to have 250. Remember, under details, you're going to have the name of the contra account, petty cash. And in the petty cash account, you're going to have the name of the contra account, which is drawings. I'll write it out neatly, as I always do, just to demonstrate it. And then you'll have the date. So now drawings was debited in this transaction, and petty cash was credited. Drawings was debited because the rule says an increase in drawings, debit. A decrease in the value of our asset on hand, the rule says credit. I actually got the flowers from my garden, a white and a purple, I think that's called purple, cosmos. So this has been typed out neatly. Remember, category was drawings, increase in drawings, the rule says debit. We've got date, the name of the other account, the contra account. This transaction would have gone through a journal, the petty cash journal, and the amount was 250. So drawings was debited, and petty cash is a current asset. The value of petty cash decreased by 250, and the rule says a decrease in assets must be credited. And there's drawings, the name of the contra account, and there's a cross-reference between drawings and petty cash. Drawings was debited and the other account, petty cash, was credited. So I'll rub it out and leave the nice, neatly typed out answer to that transaction, where the owner, Richard, withdrew 250 Rand from petty cash to buy flowers for his wife. There's the answer. So we're getting better at this, and we are understanding and applying the rules, why an account is debited and why an account is credited.
Well done. Keep it up.
Thanks, Dad. There's a bit of encouragement for all you people out there. Let's have a look at the next transaction. It says Calibu Education earned interest on their positive bank balance. So in the bank account there is money, and Calibu Education is earning interest on that positive bank balance, as the bank is using Calibu Education's money to invest elsewhere, and the cost of them using the money is interest Calibu Education earns. So Calibu Education has earned interest on their positive bank balance. I just want to see what the amount is there. 300 Rand. So we've read the transaction. We need to identify the accounts. The first account is the business bank account. The second account is interest. You know me, I will have it written out in the next slide. Interest on current account. If you earn interest or pay interest, always specify what interest it is. So the name of this account is interest on current account. Next step, we need to classify the accounts by definition. So the definition of a current asset, bank, we know is a current asset, and we have a positive bank balance. So I classify bank as an asset. The bank balance has increased. Income, it says there, is the money earned through business transactions. This is a transaction. We've earned interest on a positive bank balance. Interest on the current account is income. Here are rules. Bank is an asset. If it's an increase in the value of the asset, the account must be debited. So bank will have an entry on the debit side of 300. The contra account is interest on current account and the date. According to the rules, when there's an increase in income, and we said interest on current account, the definition is income. It's an example of income earned by the business. An increase in income, the account must be credited with 300. And under details, we will have bank. The bank balance is increasing, so this would go through the cash book receipts. I did also put here in the slide the DEADCLIC acronym, if you want to use the DEADCLIC acronym. So you have two options here. You learn your rules off by heart. You can classify these accounts: asset, income, expense, liability, drawings, capital. We've classified the two accounts involved, and we've applied the rules. So we debited bank, increase in assets, and we credited interest on current account because there was an increase in income. Okay, let's see the neat version of my scribbling. Here is the neat version. I'm liking the picture of my bank account more and more. So we earned interest. We classified bank as an asset. Our bank balance increased. The rule says debit the account. The date is the 9th. That is the name of the contra account. Interest on current account. This information goes through a journal. If the bank balance increases, which it has, it will go through the cash book. More specifically, the cash book receipts, and the amount was 300. So bank was debited, increase in assets. The interest on the current account was credited, and the reason being it's increase in income. And the rule says an increase in income, we must credit the account. So there's the 300 through the cash book receipts. The contra account is bank. And the two accounts cross-reference. They're contra accounts, bank and interest on current account. And once again, I'll quickly rub this out so you can see how it should look. Remember, I'm only using T accounts to explain this, and much earlier in the video I told you what T accounts are. So there we go. There's the solution to that transaction. We applied the rules. Bank was debited and interest on current account was credited. You are now becoming masters of applying the rules to transactions. In this slide, I'm going to look at the following transaction. You're going to record it. Calibre Education purchased a new laptop for the business. Paid cash for the computer, 12,000 Rand. I haven't put the steps up here because you should know the steps. I haven't put the rules up here because you should know the rules by now. So let's go about this. Step 1, read the transaction. I've done that. Step 2, identify the accounts involved. There was cash involved here, and this came from the business bank account. So the one account is bank. What did we buy? We bought a laptop. We might have an account called computers. You might put your computers under equipment, but for this, let's just say we call the account computers. Now, by definition, okay, we have a positive bank balance. So bank is an asset. Computer, it has value. I'm going to keep this laptop for a period of time. We own the computer. Calibre Education owns the computer. It's actually a non-current asset, but asset will do. So what happened to our bank balance? Our bank balance decreased. The rule says a decrease in assets, we must credit the account, 12,000. What happened to the value of our computers at Calibre Education? The value on the date of purchase increased by 12,000. By the way, that's the historical cost price of this computer, 12,000 Rand. So we debited because there was an increase in the value of assets. Bank, that arrow there is a decrease. So the bank balance, there was a decrease in assets, the account was credited. Computers was debited. We must fill in the name of the contra account, bank, and under bank we will have computers, This would have gone through the cash book payments. Cash book payments. There we go. There's the link to the two accounts. They're contra accounts. And now we've applied the rules to bank and computers. You guys are now experts. All you need to do is you need to practice. So you take your textbook, you find transactions, you find a piece of paper, and you scribble T accounts, and you deal with all the transactions. You debit them and you credit them, right? Practice. You need to practice. And typed out neatly. The one account was bank. These are just folio references. It means bank is balance sheet account number 5. Financial position account number 5. Computers is financial position account B6. So from the previous slide, bank was credited, decrease in assets. Computers was debited, increase in assets. I applied the rules there. This transaction took place on August 12th, 2023. You guys are now experts at debiting and crediting general ledger accounts. You know why an account is debited and why an account is credited. Well done, everyone. You are experts. That's my late 90-year-old Gran saying her alphabet backwards when she was obviously still alive. So what's the moral of the story? You need to know your accounting rules backwards. If you do, you're going to have a successful accounting career. Caleb thinks that's funny. Maybe it is, but you need to know your rules. You need to know your rules backwards.